Good afternoon, ladies and gentlemen, and welcome to the Lords Group Trading PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, all of the questions submitted today will be reviewed, with responses published on the Investor Meet Company platform where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand over to CEO Shankar Patel. Good afternoon, sir.
Good afternoon. Thank you for taking the time to listen to us this afternoon. Joined with me today, I'm Shankar Patel, the CEO, joined by Chris Day, our CFO. On the agenda, we are going to take you through some slides which will include highlights for the first half of the year, financial review by Chris. Between myself and Chris, we'll talk about our strategic update, and then we'll finish with a summary and an outlook for the rest of this year and into 2023, followed by Q&A. On this slide, you'll see the highlights. Three major blocks. One is that we're on track to deliver our market expectations for full year 2022. We have still got significant market share opportunity. Lords currently is less than 1% of the 55 billion pound building materials market, and we're on track to deliver our strategic progress, which is to reach 500 million in revenue by 2024. That is well within reach. In particular, on our market expectations, we're really proud that our overall H1 revenues have come in at 19.7% above 2021, and from that revenue growth flows a really decent EBITDA growth of 27.1%, including in that is the margin accretion to 6.6%. Our market share opportunity is really significant because we have got tremendous amount of organic growth levers that are still within the business. These are around product range extension, the further deployment of digital initiatives, and the fact that we have brands which we can grow through new sites. Our acquisition opportunities are still plentiful, with the market consolidation still strategy still in place, and with lots of opportunities for us there as well. Our medium-term margin target of 7.5% EBITDA is still on track. So overall, what we're saying is that the customer demand remains robust, and our board expectations are unchanged for the full year of 2022. Chris will take you through some of the financial highlights on the next page.
Good afternoon, everybody. So the highlights for H1 22, as Shankar said, revenue of 214 million and 19.7% step forward in terms of growth. Adjusted EBITDA margin at 14.2%, so representing a 27.1% improvement in EBITDA. That flows through into some really strong progression around EBITDA margin that we're very pleased with at 6.6% for the half year. That's 40 basis points ahead of the comparative period in H1 21 and 50 basis points ahead of the full year 21. And we'll talk through how that's evolved as we go through the two divisions. Adjusted profit before tax at 8.5 million, full year consensus being 16, so you can see we're well on track to deliver that number. In terms of cash flow, positive in the half year. Cash flow generated by operations at 12.8 million, a 33.6% improvement. We've got a slide that takes you through that in more detail, but principally very well controlled working capital, and then flowing through into free cash flow is CapEx, and we'll talk around some of the timing elements there shortly. Interim dividend announced of 0.67 pence per share, step forward of 0.04 pence per share on the half year. And I think really kind of takes us another step towards our IPO commitment of a progressive dividend policy that reaches 3 times cover in the short term. At balance sheet date, net debt on a pre-IFRS basis is 21.1 million. The comparator being H1 21 at 25.6. Obviously, quite a lot has happened in those 12 months post balance sheet H1 21. We've had the benefit of the IPO proceeds, and then subsequently completed 5 acquisitions that take us from a net cash position post-IPO back to a comfortable net debt position of 21 million and circa 1% leverage. Moving on to merchanting, really strong performance here for this brand, for this division. A revenue of 105.9 million, 14.5% like-for-like growth. So that's the organic levers that we talk about in our strategy, really driving great momentum through product range extension, new site openings and digital, and overall, including the benefit of acquisitions, 73.4% revenue growth, adding 44.8 million in the half year. That drops through to adjusted EBITDA of 7.7 million versus the comparator, the previous year of 5.3 million and a 45.4% step up. You can see on the final line in that table, the margin moves to 7.3% EBITDA margin. And that really is, it's aligned to our expectations, but it's attributed to an element of customer mix and then also the lag in terms of pass through to our customers. Inflation has been a real kind of dominant factor in the first half year, and we consciously took the decision to respect those long-term customer relationships that we've established and pass through in a manner that we thought was affordable and would maintain relationships. Ultimately, that pass through is now fully resolved, and we'd expect to see the H2 EBITDA margin recovering back towards full year 21 and beyond. In terms of plumbing and heating, I think really, fantastic performance. If merchanting gets the plaudits for the revenue, then plumbing and heating gets it for the way it's dealt with the adversity of the boiler supply issue. Like-for-like revenue reduction of 12.5% at 108.3 million, 8.2% negative, including the benefit of the direct heating acquisition that we made in April. But most pleasingly is management's response, and that's come through product range extension, through pricing decisions, and through driving energy efficiency technology products that have becoming a growing part of our product range. All of that's flowed through to an adjusted EBITDA of 6.5 million against 5.9 in H1 21. It's a 10.6% improvement in EBITDA and drives that margin to 6% for the division, 5% against H1 21, and 160 basis point improvement versus full year 21. So really, really pleased. And for those that were with us on the full year results presentation, you remember we spoke about the fact that plumbing and heating had been through a 2-year investment program and transformation. We've invested in taking the business from literally pen and paper to a fully functioning ERP system. We've strengthened the management team, adding lots of relevant sector knowledge and experience, added capacity to the branches, and all of that is enabling what you're seeing here. This isn't a one-time shot in terms of improvement. We expect a continued progression in this division over the next couple of years, aligned to our targets for the group. Cash flow, we covered some of this briefly. We start with adjusted EBITDA at 14.2. You can see modest working capital movement at 1.1. I think we've dealt with that really well. Trade debtors are behaving. Bad debt is low, and customers continue to pay on time. Stock has a bit of movement to come in H2 as the boiler supply issue eases. That will yield some increased stock holding as we return to normal levels of holding in the plumbing and heating division, but overall a number that we're very comfortable with. Tax, you can see quite a big movement year on year. That's timing that will wash through in the second half of the year, and that takes you down to adjusted cash generated by operating activities of 11 million, capex of 1.9 and interest of 0.5. Capex very much front loaded through the transformational refurbishment of our Lords Builders Merchants Beaconsfield branch. That was fully opened in May, and then we've got some lumpiness in the way that the fleet investment has come through. 0.6 million in the first half. It would probably be 0 in the second half. Consensus is 3 million on the capex, and we expect to be below that for full year 22. And all of that kicks out free cash flow of 8.7 and healthy conversion that then stimulates the organic growth, the acquisitive growth, and the dividend policy.
So in terms of a strategic update, we want to reaffirm our investment proposition. The business has fantastic organic opportunities. It still has a healthy pipeline of acquisitions. It is pursuing a digital strategy which is bearing fruit, and we'll talk about that in a minute. And we're embedding ESG in our decision making, not just to meet our commitments on that front, but also to make our business more efficient. In terms of organic proposition, we've got a significant opportunity to broaden our product range. Over the last few years, we have been building scale. With that scale, we have a platform, and with the platform, we can now add additional products and get growth through that addition. We're also seeing a transmission to us being involved in the energy efficient technology that is now starting to bear fruit in the UK. A lot of it's coming from customers and a lot of it's coming from suppliers. We sit very comfortably in the middle as a distribution platform that both parties need in order to meet the growing demand. We then also have multiple brands with expansion potential. Chris will talk about that in the next few slides. The acquisition pipeline still remains active. The point to make is that really we have a discipline when acquiring business, and that is to have a pricing mechanism between 4 to 6 times maintainable EBITDA. And the operative word being maintainable, and that is our forecast of maintainable. It's based on what we see a business performing in the future, and we will only pay between 4 to 6 on what we see that business doing in the future, and not necessarily paying for heightened performance in the last few years, and for not discounting the fact that in some cases in an acquisition they have a performance issue going into the future, especially with some headwinds that we're all forecasting. On the next slide, I think Chris can talk a lot more about the detail.
Yeah, I think the next 3 slides give you some specific examples around the organic growth, and I think it's important to understand and realise the quantum of the opportunity there, because the acquisitions get the headlines more often than not, but actually the underlying business has a track record of delivering organic growth, and these next couple of slides give you a flavour of how that will continue to happen heading into the next few years. So energy efficiency technology is a really exciting opportunity for us. As Shankar said, we're blessed with two types of demand. One, the customer is coming to us requesting the product, and 2, the manufacturers are coming to us seeing us as a credible route to market. We offer our in-house distribution platform offers a route to market to the independent merchant, to the installer, and to the end user. These product ranges for us are attractive because we're delivering to existing customers an extended product range, which is very efficient, and they're also accretive in terms of gross margin versus the core product range of the plumbing and heating division. You can see overall in H1 a 64% growth in terms of revenue and how that's split between some of the different categories across air source heat pumps, smart home technology, underfloor heating, and electric boilers. And I think ultimately we feel that this will be a growing opportunity for us. If we have a 15% share of supply of boilers in the UK, we have less than 1% share in this area, and it's something that we can absolutely step forward on and really help our customers. The second organic lever to understand is the expansion of certain brands. We're a portfolio of brands. There are 12 in total in the group, and bar APP Wholesale, which is the distribution of plumbing products to the independent plumbers merchant network across the UK. The rest of them are relatively regional, and some of them have the right characteristics to grow out of that regional presence into a more national profile. And the starting point is that they need a sound customer proposition, something that resonates and attracts the customer, and that they have a proven track record of growing their customer base and their revenue. Then in the full year results, you'll recall that we were talking about a 20% return on investment expectation, and that we want our accretive additions, being organic and acquisition, to drive that EBITDA margin north towards our target of 7.5%. And we think these two brands on the screen are both capable of doing that. Today, Mr. Century Eating has 9 locations across the UK, but largely focused in the south of England, as you can see from the map. 55 million of revenue, of which 25% is digital. We think that digital kind of split is really strong when you look across the market, and there are not many multi-channel brands that offer online and in-store, delivering a 25% split in terms of digital revenue. And we want to take this brand and take it forward to 50 locations, and that really then targets some of the 50 of the biggest conurbations in the UK. We're not looking to pitch this into small markets. We think it can thrive in big conurbations, and the 10th branch, and the first one for 12 years, will open in West Bromwich next week. So facing into the Birmingham market, being the second largest conurbation in the UK, and should make a great start with a really strong and experienced local management team that have come from one of our national competitors. Yesterday we signed off branch 11, and that'll be coming to market and opening in Q1 23. In terms of George Lyons, specialist civils merchant, it's respected for the product knowledge, the service, and the specialist product range that we stock. It's a 2016 acquisition. It was 1 location, and it was 13 million of revenue at the time. It's now 3 locations and 25 million of revenue, and we think it's really realistic when you look at that graph to kind of take it and grow it at the spine of the UK. When we bought the business, it was operating out of Slough. In 2019, we added Aylesbury, and in Q2 this year, we've added Horsham. Again, Horsham, it's a management team that have come from a regional competitor, and the site has got off to an exceptionally good start, and we're now actively looking for location 4 to add to the map. So two really good examples where you could take you could quite easily take the incremental number of stores and the average revenue and the discipline around returns and EBITDA margin, and kind of convince yourself of quite significant organic growth over the medium term. And then the final example is around digital, and really to help people understand why we see digital as being such a good fit for us. And it goes back to that point around, we think that the product range is broad. The general builder's product knowledge is not always perfect, and that's our role to help complement them in terms of product knowledge and selection. And we think that online and in-store allows them to move freely between the two as they see fit. We've got 3 different customer types on this page: trade, who are looking for the time saving; do it for me, who are looking for the advice and the end-to-end service; and then do it yourself, who are looking for the choice and the help and the delivery. And we're not precious about how these customers come to us. They can start their journey online and finish offline, or vice versa. Our teams are completely aligned to and incentivized on their brand revenue rather than channel revenue. So there's no what we don't want is a situation where we're trying to force our customers down a channel that they don't want to go because of the way our colleagues are incentivized. So everyone in our group loves digital. They see it as a really strong funnel for new customers. And we have some really good case studies. There's one that we've been talking about today as we've been talking to the various stakeholders. One customer came to us, £38 aggregate bulk bag, delivered, and placed the order through the website. There's not a lot of profit in that single transaction. But what we then do is follow up with our internal sales team, who understand the opportunity. The opportunity was bigger than the £38 bag of aggregate. We send an external sales rep out, and they build a relationship, open a credit account. And in the first half of this year, that customer spent £25,000 with us offline. So that's a really good example of how you can take £38 online and turn it into £25,000 offline. And if we look after that customer in the way we look after all of our customers, they'll be with us for 5-10 years and beyond. And we're able to take what Mr. Central Heating, which is a really mature model, as I said on the previous page, from a digital perspective, and we've taken some of the team that were inspirational in the early days of Mr. Central Heating establishing itself, and we've taken them into the merchanting division, and you can see in the results, okay, off a small base, but a step forward, merchanting has gone from 2.2% of revenue online to 3.4% online in this half. So real momentum there, and making the most of the digital opportunity in whichever form the customer ultimately transacts. It also helps that everything is in-house. So it's an in-house development team on the website, in-house distribution, and that makes the whole thing much more cost effective. You can see some of the pure play online guys, once they've paid for the marketing with Google and once they've paid the courier company, there can often not be a lot left at the bottom. We don't have that challenge because we have an in-house platform that's leveraged, and this is incremental volume. For those that were with us on the full year results, this will be a familiar slide, but just to reaffirm, we think we are well on track on the left hand side for the 500 million of revenue by 2024. I think if you were to annualize the run rate of the H1 acquisitions that we made, the 4 transactions, we are kind of comfortably on our way to that run rate of 500 million. And on the right hand side, we put this target out at the full year results, as I said, at 7.5%. At that point, we were sat at 6% EBITDA margin and maybe 7.5%. Needed some clarity in terms of execution, but with the half year results delivered at 6.6%, we're now well on the way to delivering that as well over the medium term.
Thank you, Chris. So I'm going to wrap up our presentation with providing you with the outlook and summary. Key point to reiterate is that we are still small, with less than 1% of a pretty significant market. We're entrepreneurial, we're professional, and we're very agile. So we can react to changes in external circumstances very rapidly. We've proven that with the boiler supply issue that we've had this year, and the fact that we've managed inflation as well as supply chain pressures, delivered a strong set of H1 results. Our customer demand remains robust in our RMI segments. RMI tends to be aggregated. However, we are in the repair and improvement element of RMI, the maintenance element, which is akin to more the DIY sheds, things like places like Wicks and Homebase and Toolstation. That is not where our business is focused. We're much more in the improvement and the repair side, and we see still robust demand in those two segments. Our acquisitions are performing very much in line with expectations. We have maintained discipline in the acquisitions that we've made, paying an average of 4.6 times maintainable EBITDA. We reiterate the significant organic growth levers. We've just been through a good number of them, and all of these will lead us and allow us to target our margin expansion towards 7.5%. Overall, trading is in line and in line with our expectations for full year 22, and we are on track to deliver our IPO commitment of reaching 500 million revenue by 2024 with a 7.5% EBITDA margin. So that concludes our presentation. We're more than happy to take questions.
Shanker, Chris, if I may just jump back in there, and thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team takes a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Shankar, Chris, we did receive a couple of pre-submitted questions ahead of today's event, as well as a number of questions that have been submitted throughout today's presentation. So firstly, thank you to all of those on the call for taking the time to submit their questions. And Shankar, Chris, if I could please just hand back to you to run through that Q&A tab, and where appropriate to do so, if you could please just read out the questions and give your response, and then I'll pick up from you at the end. Thank you.
Sure, no problem. So the first pre-submitted question was, ordinary investors often feel great comfort in sitting alongside a CEO who owns a large stake in the company. You talked about your 30-year career and the journey through the ranks at Lords before, but can you explain briefly how exactly your large shareholding of nearly 30%, 33% came about?
So the business is effectively a family business, and I joined, whilst it wasn't my father's business, I joined the business in 1991, and it was at that point that I took a 50% stake in the business. So I was straight out of law school, couldn't get a job as a lawyer during those difficult times in the 90s recession, joined the business and was then able to take a significant stake in the business. And that's principally how I've arrived at my stake. And over the 30 years, obviously, I've grown the business from being an owner-managed business to something that's professionally run, with still the family holding a significant share in the business.
The next question is from Andy M, and it is, what cash payback do you look for in a new site rollout, and how the local incumbents typically react to you entering the market? In terms of payback, so we ultimately at maturity, we talk about a 20% return on investment, but payback would be within a 5-year horizon, and more often than not, we'd be striving for that to be closer to four years in terms of payback. So that's the first half. And then the second half, I think kind of competition is something merchants are used to and relaxed by. I think the brands that we're rolling out sit in quite unique spaces within their markets, and we deal with it and find our place in each market.
I think also to add to that, we don't actively target any competitor's business. Right? So when we enter into a local market, because markets are quite large, effectively the share we take is small amounts from various competitors rather than targeting one particular competitor and gaining share that way. So the reaction tends to be a lot less aggressive from our competitors, because they don't really see a direct immediate impact when we enter into the market.
Nick B, what benefits are you seeing from applying your digital strategy to the acquisitions? Do you see an additional uplift in return? Yeah, and so yes is the answer. And I think a really good example is Condell. It's a brand that sits within our merchanting business. Quite a large part of its revenue is online. And actually what we've been able to do with our merchanting and Mr. Central Heating teams is really optimize their website. We've added product range, we've improved the search functionality on the website, we've improved the way you get from homepage to product to checkout, and all of those things have made a real difference to the conversion rates that we're seeing on the website, and ultimately the lift that we're getting in revenue off the back of that. And I think typically when we buy a performing business, and in those cases we will often rebrand it into one of our existing merchanting brands, you get the instant uplift because you immediately take that presence into those markets. And we're almost doing the reverse on Mr. Central Heating. So it has such a strong online customer base that we're using that online customer base to determine where the next new branch should go as well in reverse. So it goes both ways in terms of the synergies.
Right.
Fine.
Ollie D.
Yeah, right. Ollie D. I'll let Shankar answer this one. What did you learn in the financial crisis and other recessions that will help you through the predicted slowdown this winter? and how are you looking to implement what you have learnt?
So the key learning, and having started in 1992, which was a pretty tough downturn at that time, seeing the dot-com bubble, the great financial crisis, and COVID, our business has grown in each of those downturns. And the simple reason is because, as we've always said, we focus on two key stakeholders, our colleagues and our customers. And in a downturn, it's most important that you actually really focus on those. So increase customer service and the customer experience levels, ensure colleague engagement is as high as it could possibly be, and that's where management should be focusing. And then invest in your business. So we've always invested through downturns. And the reason why we do that is most of our larger competitors either won't or can't. And their approach to downturn is diametrically opposite to our approach. We would go and invest in our business to provide our customers with far better customer experiences than they had before. And that allows us to gain market share. Many examples, but the great financial crisis, the merchanting market was down by 20% in 2009. Our business grew by 2%. Again, what we did was focus on providing our customers same day or guaranteed next day delivery. That was a major part of the issues that our customers were facing. As we head into the current downturn, again, in each of our individual businesses, our local branch managers, who are really the entrepreneurs in our 45 plus locations, they will be looking out to see what initiatives can they employ or deploy to make sure our customer service proposition is even better. And to give you an example, if there's a truck which is half empty, we would expect them to call a customer and say, I can make a same day delivery to you. Do you want some products? And just simple things like that will allow that business to grow, because unfortunately what our competitors will be doing in a downturn is actually reducing capacity to try and make sure that they fit their costs in line with the predicted downturn. Unfortunately, when you reduce capacity, quite often what we've seen in our markets, you actually drive that revenue line down because you've actually taken away that customer service proposition that you had. And there are many other examples of the kind of things that we tend to do in a downturn. But like I said, in summary, it is focusing on excellent colleague engagement that then leads to excellent customer service and experience.
Okay. And then I think Ollie has teed up nicely the other pre-submitted question, which is, I'm sure that the board is fully aware of the Bank of England's recent gloomy forecast of 13% inflation and up to 5 quarters of recession for the UK economy starting in Q4 of this year. To add to that, the ONS recently published that construction orders were down 10.2% in the second quarter of this year. If a serious recession were to happen, would this in any way affect the company's growth plans for the group in the short term and derail the board's target ambitions of achieving 500 million in revenues by 2024? Do the board, for instance, have any contingency plans? I think I'll have a first crack at this, and then why don't you contribute off the side? So I guess construction orders down 10.2% in the second quarter. You can see from our results that that's not consistent with what we're experiencing. We continue to experience strong like-for-like performance, and we've been saying to people today that actually July and August have been our best two like-for-like months of the year so far. And we think the reason that we're getting that differentiation is the point Shanker was raising earlier around the discrete elements that we sit within RM and I. So very much focused on the R, so that's repair, and we'll all go home to our homes tonight, and they all have heating and hot water in them. So the demand will always be there for that side of our group. And then on the merchanting side, we think we're more into the improvement side, but very much focused on the homeowner who is mid to high income. They're still sat on record levels of savings at the moment, and they are focused on driving improvements into the home and not proportionally impacted by the cost of living challenges that exist. And we're still continuing to see demand from them in our monthly sales figures, but also from anecdotally from our trade customers who talk about being busy all the way through to the end of the year and to normal levels. In terms of the scenarios and the 13% inflation, yeah, we like to kind of model downturn scenarios as early as they land. We were modeling COVID lockdowns at the beginning of February, before, we real kind of like a real paranoid approach to potential problems. And we've been modeling off a 12% inflation. And we think that we can absorb what that would bring in terms of forecasts, and kind of the general economist view seems to be that 12% inflation would potentially be a 5% downturn. I don't think that would be a 5% downturn for us for the reasons I've just articulated, particularly around the R element of our structure. But then we have a huge opportunity from organic levers to outperform the market. So if the market is -5, we would expect to outperform that market through our organic levers, being product range extension, new geography, and digital.
And just to add to that point, one of the things that the business is always pride itself on is to approach professional management with a degree of paranoia. We know right now, whilst we don't see it in our numbers, we know there are headwinds, and so our scenario planning and the modelling shows us if there's a downturn, what the impact is. But more than just knowing the impact, it's what are we going to do about it. And that's what's really helped this business continuously, is to look at a problem scenario that might be occurring currently or might be coming, and then saying, what are you going to do about that? And effectively executing what I call a countermeasure set of actions that then lead you to effectively outperform. We've done that with the supply chain issues we've seen, especially around boilers. We called the issue very early on, made a public statement, but really what we were saying is that we're on it. And that's effectively how this business, because again, it's an entrepreneurial, owner-managed type of business with 45 to 50 branch managers, general managers, and colleagues below, all of whom are constantly looking at the issues that they face or are going to face, and what are they going to do about it. And I hope that gives you a very clear sort of proposition of why in downturns we grow. It's because we plan it early, and then we plan what we're going to do about that downturn. So I suppose to answer the question is, does the board have any contingency plans? Yes, as always, a good business should always have a contingency plan.
Okay, and I think that's the last question. Yeah.
Shanker, Chris, absolutely. And if I may just jump back in there, and thank you very much indeed for taking the time to address all of those questions that came in from investors this afternoon. And of course, if there are any further questions that are submitted today, we'll make these available to you immediately after the presentation has ended for you to review. And ladies and gentlemen, we'll publish all those responses where it's appropriate to do so on the Investor Meet Company platform. Shanker, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Well, firstly, we are meeting the IPO commitments that we made in July last year. Our first half results are testament to the fact that we are a business that does what we say we're going to do. We're on track to grow our business through a very experienced management team that have been through multiple downturns. And in each of those downturns, we have thus far managed to grow our business. And we hope to be able to continue doing that as we head into a slightly more difficult period in Q4 of 2022 and potentially beyond into 2023. Thank you very much for your time.
Thank you.
Shanker, Chris, that's great. And thank you very much indeed once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Lords Group Trading PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.